Every dollar in your bank account doesn't actually exist. Not physically, not in any vault, not waiting for you behind a teller window. The number on your screen is a promise, a digital entry in a ledger, and the system built around that promise is so vast, so layered, and so deliberately complex that the people running it would prefer you never fully understood it. Right now, the USM2 money supply, that's the broadest measure of money in circulation, sits at roughly $21 to $22 trillion. But here's the part nobody teaches you in school. The Federal Reserve didn't print most of that. Banks did. Your bank. Every bank. Through a mechanism that most adults have never heard of, trillions of dollars get conjured into existence every single day, and the system that moves that money across the country and around the globe processes more value by 9 a.m. than most nations produce in an entire year. So let's decode it. From the ground up, no textbook language, just exactly how it works. Start with the Fed, because that's where most people think money begins. The Federal Reserve does not print dollar bills and mail them to banks. That's not how it operates. The Fed creates money by buying assets. Specifically, it purchases U.S. Treasury bonds and mortgage-backed securities from commercial banks and other financial institutions. When it does that, it credits the seller's reserve account, an account that bank holds at the Fed itself. No physical cash changes hands. The Fed just types a number into a computer, and that number represents real purchasing power. This process is called open market operations, and it's been the core tool of monetary policy for decades. When the Fed wants to inject money into the economy, it buys bonds. When it wants to pull money out, it sells them back. After 2008 and again after 2020, the Fed went into overdrive, buying bonds at a scale the world had never seen. The program got called quantitative easing. By 2022, the Fed's balance sheet had ballooned to $8.9 trillion. That's $8.9 trillion in assets the Fed created by crediting reserve accounts into existence. As of early 2026, after years of letting assets roll off the balance sheet, the Fed still sits at around $6.6 trillion, nearly triple where it stood before the financial crisis. But here's where it gets genuinely strange. That money the Fed creates, it mostly sits at the Fed as bank reserves. It doesn't automatically flood the economy. What actually floods the economy is what commercial banks do next. When you deposit $10,000 at Chase, Chase does not lock that $10,000 in a safe. It takes most of it and lends it out. That $10,000 becomes a $9,000 loan to a contractor who deposits that $9,000 at his bank, which lends out $8,100, and on the chain goes, each deposit spawning a new loan, each loan becoming a new deposit somewhere else. This is fractional reserve banking, or more accurately, it used to be. In March 2020, the Federal Reserve did something remarkable. It dropped the reserve requirement to zero. Banks are now legally required to keep exactly none of your deposit on hand, 0%. They maintain reserves anyway, for operational reasons and because regulations govern their capital ratios. But the formal floor is gone. The practical implication is that banks create money through lending, essentially from nothing, constrained only by demand for loans, creditworthy borrowers, and their own balance sheet limits. Before the reserve requirement was dropped, the textbook example used a 10% ratio, meaning a $10,000 deposit could theoretically generate $100,000 in total money through the multiplier chain. The reality is messier than that, but the core mechanic is real. Banks manufacture money every time they approve a loan. Stop and sit with that for a second. Every mortgage, every car loan, every business line of credit, each one of those is new money entering the economy, not recycled money, not saved money someone lent out, new money, created at the moment the loan is approved. And when that loan is paid back, that money is effectively destroyed. It vanishes from the money supply just as cleanly as it appeared. The money supply breathes. It expands when banks lend aggressively and contracts when loans are paid down or defaulted on. The Fed doesn't control it directly. It nudges it by adjusting the interest rate banks pay to borrow reserves, the federal funds rate, which makes lending cheaper or more expensive, and therefore makes the money supply grow faster or slower. That's the lever, not a printing press. A rate. Now, once that money exists, how does it actually move? When your employer pays you, that paycheck doesn't travel as cash. It travels as a message. Your employer's bank sends an electronic instruction through the ACH network, the automated clearinghouse, telling your bank to credit your account. ACH is the plumbing for everyday money movement. Direct deposits? bill payments, recurring transfers. In 2025, the ACH network processed 35.2 billion payments worth $93 trillion for the full year. That's an average of 141 million transactions every single business day. The dollar value moving through ACH alone exceeds the size of the entire U.S. economy every few months. But ACH is the slow lane. Banks also move money through Fedwire, and Fedwire is where the real weight moves. Fedwire is the Federal Reserve's own real-time gross settlement system. Every transaction settles immediately and with finality. No waiting, no netting. When a bank sends $500 million through Fedwire, that $500 million moves in seconds and it's done. In 2024, Fedwire processed an average daily value of $4.5 trillion per day, every business day. To put that in perspective, the U.S. GDP for all of 2024 was around $29 trillion. Fedwire moves the equivalent of that in about 6.5 business days. And then there's SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT doesn't move money, a common misconception. It moves messages about money. Secure, standardized instructions between banks in 200-plus countries telling each other what to send, to whom, in what currency. By mid-2025, SWIFT was processing over 47 million messages per day, supporting $150 trillion in cross-border payments annually. When you wire money internationally, when a corporation settles a foreign acquisition, when a country services its dollar-denominated debt, those instructions all run through SWIFT. It is the nervous system of global finance. And because the US dollar runs through most of it, America holds enormous structural power over the entire network. Being cut off from SWIFT, as Russia discovered after 2022, is the financial equivalent of being cut off from oxygen. One more layer most people never think about: intraday credit. Every morning when Fedwire opens, banks routinely send out billions of dollars before they've actually received the funds to cover it. The Federal Reserve extends them daylight overdrafts, essentially free intraday loans, so that the system doesn't grind to a halt waiting for receipts to match outflows. On a busy day, the Fed extends hundreds of billions in intraday credit that gets repaid by close of business. The whole thing runs on trust, collateral, and the Fed's willingness to be the backstop. Remove any one of those, and the daily plumbing seizes up. Now we need to talk about shadow banking. Because what we've covered so far is the visible system, the regulated system. But running alongside it, and in 2008, nearly destroying it, is a parallel financial universe that most people didn't know existed until it almost collapsed the global economy. Shadow banking refers to lending and credit creation that happens outside traditional regulated banks. Money market funds, hedge funds, securities dealers, asset-backed commercial paper, structured investment vehicles. These entities perform bank-like functions. They borrow short, lend long, and create credit. But they don't have access to the Federal Reserve's emergency lending window. They don't carry FDIC insurance. They are not subject to the same capital requirements that govern deposit-taking banks. They operate in the gaps. Before 2008, the shadow banking system in the U.S. alone was estimated at $25 trillion. Globally, some estimates put it at $60 trillion or higher. And the fuel that kept it running was the repo market, short for repurchase agreements. Here's how it works. A financial institution needs cash overnight. It hands over a bundle of securities as collateral, borrows cash, promises to buy those securities back the next morning at a slightly higher price. The difference is the interest. Repo was the lifeblood of the shadow banking system, the mechanism by which hedge funds and securities dealers funded their massive positions day after day. When the subprime mortgage market started cracking in 2007, repo lenders looked at the securities being posted as collateral and got nervous. What if these mortgage-backed bonds aren't worth what everyone said they were? They started demanding more collateral for the same loan, bigger haircuts, or they stopped lending altogether. Firms that relied on overnight repo to fund their operations suddenly couldn't roll their positions. Bear Stearns, in March 2008, ran out of road in days. Lehman Brothers followed in September. The repo market froze. The shadow banking system experienced exactly the kind of run that traditional bank regulation was designed to prevent. Except nobody had built a safety net for this version of it. Here's the number that captures the scale. In the 4 years before the crisis, repo liabilities at major U.S. broker-dealers grew by 2.5 times. 2.5 times. Nobody rang an alarm. Nobody required a capital buffer. Nobody stress-tested it. And when it unwound, The entire global financial system nearly went with it. Today, shadow banking is bigger than ever. The Financial Stability Board estimates that non-bank financial intermediation, the sanitized name for shadow banking, now accounts for around $250 trillion globally, or roughly 49% of the world's total financial assets. Hedge funds alone manage 15 times the assets they held in 2008. The risks have shifted, evolved, and grown. The regulations are tighter in some areas and completely absent in others. Whether a similar run could happen again is a question that serious economists argue about constantly, and not all of them say no. So where does the system go from here? Central bank digital currencies, CBDCs, represent the most fundamental redesign of the monetary architecture since the dollar left the gold standard in 1971. A CBDC is not a cryptocurrency in the Bitcoin sense. It's digital money issued directly by a central bank. No commercial bank in the middle. No fractional reserve multiplier, just a direct digital liability of the Federal Reserve sitting in your digital wallet. The implications are staggering. If your dollars live directly at the Fed, banks lose their role as money creators. The whole lending creates money mechanism gets short-circuited. A CBDC could allow the Fed to deposit money directly into citizen accounts during a crisis. No stimulus check delays, no bank skimming spreads. It could also allow the government to program money, to attach conditions to where it can be spent, or to apply negative interest rates automatically during recessions. As of early 2026, 137 countries representing almost the entire global economy are actively exploring CBDCs. China has processed $2.37 trillion in digital yuan transactions and made its CBDC interest-bearing, something no other major economy has done. The Bahamas, Jamaica, and Nigeria have fully launched retail CBDCs. The UAE went live with its digital dirham pilot in November 2025. India's digital rupee circulation jumped 334% in a single year. The United States, meanwhile, moved in the opposite direction. President Trump issued an executive order in 2025 explicitly halting all work on a retail U.S. CBDC, making America the only major economy to formally pump the brakes. Whether that's a protection of financial privacy, a defense of the commercial banking sector, or just political positioning depends on who you ask. But the rest of the world is not waiting. What's clear is that we are living through the largest renegotiation of what money is and who controls it since the Federal Reserve Act was signed in 1913. Every system we've walked through, open market operations, fractional reserve lending, ACH, Fedwire, SWIFT, shadow banking, CBDCs, is not a permanent, natural feature of the universe. These are human inventions. They were designed by committees and lobbied into existence and reformed after every crisis. And they will be redesigned again. The people who understand how money actually moves will be in a completely different position than those who just watch their balance go up and down and assume the rest takes care of itself. Because it does take care of itself, just not always in your favor. So here's the question I want to leave you with. If commercial banks can legally manufacture money every time they approve a loan, and the reserve requirement is literally zero, what does that tell you about how hard you should actually be working to save a dollar versus leveraging the same mechanics the system uses on itself? Drop your answer in the comments. I want to see where your head goes on this. If this broke something open for you, share it with someone who thinks money is simpler than it is. Because what you do with knowledge like this matters. Hit that like button if you want the algorithm to keep sending you this kind of content, and make sure you're subscribed, because next week we're getting into how the petrodollar actually works, and why the slow unraveling of that system is already changing what your savings are worth.